Welcome to the VITV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner Hari.
Hello.
Great. In this episode, we are going to talk about the risk associated with owning Alibaba and the valuation. All right. So before we get started, Hari, quick disclaimer, please.
Yeah, this is the VITV podcast. We're a podcast that entertains and educates you about the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation, so please consult with the appropriate advisor before making any investment decisions.
Awesome. So Alibaba, just to quickly recap, it's a company most of you guys know, but it's basically, think of Amazon in China. They have a huge retail business, but they also have a thriving cloud business. They're expanding outside of China into Southeast Asia and to Middle East. They have a very long-term vision. They're currently listed in American exchange, so you can get your hands on Alibaba stocks easily like that. So in this episode, we're going to talk about the risk and the valuation. So let's get started. Risk. So what are some risk? What are some risk associated with this company, Hari?
Yeah. So normally when we get to this point in the discussion, we're talking about business related risks and things like that. But the overarching concern that most people have, and if you've looked at the stock price over the last 3 or 4 years, you've seen it slowly trend downward. And anytime there's new news from the Chinese government, it tends to hit the Alibaba and many other Chinese stocks pretty hard. So unlike the U.S., Chinese economy is kind of very tightly controlled by the Chinese government, and we've seen, there was a realty group called Evergrande in China that owned a huge percentage of. They had like $300 billion in debt and owned a large, amount of real estate across, China. And they ended up going into default because of bankruptcy and things like that, because they can no longer make their debt payments, and that's going to have a huge ripple effect on China's economy and so forth. China has become, under President Xi, has become more controlling of the economy as Xi has been named dictator for life and things like that. And what that has ended up doing is they're meddling more and more in the economy. So Ant Financial was one of the homegrown kind of initiatives from Alibaba that was a facilitator of payments. It had a lot of features. People were using it for health insurance in some ways. There was a lot of things that were going on with it. The Chinese government got very uncomfortable because it represented a huge percentage of transactions between people, and Alibaba was not as forthcoming as as the Chinese government wanted to be with that. So they kind of pulled back the curtain on Ant Group. Ant Group was going to have its own IPO, and China kind of shut it all down. And so now Ant Group is an unconsolidated related party, which is it's hard to know what to do with that. And for our purposes, I'm kind of not even gonna to go there. But really, what we have to be concerned about is China gets uncomfortable with the size and scope of Alibaba and starts putting limitations on its growth. They may start, the regulators may not approve any purchases by Alibaba of competitors and things like that. Because when you get to a certain size, one of the ways that you compete is buying out your competitors. And if Alibaba isn't able to do that, then that means that they're not going to have the same ability to compete with smaller, more nimble companies. So, there are definitely benefits to their scale, their size, and so forth. But I think one of the biggest risks is that size and scale is now a detriment, in the eyes of regulators in China. And what'll that do in the next 5 to 10 years? It may be nothing. It may be fairly significant. It may mean that they have to break up the cloud business from the retail business, it may mean that there are significant changes that they may have to do, or they may have to divest of international businesses to compete with the regulatory market. It's very hard to say. And then from an investment perspective, one of the concerns is that China is saying that you can't be listing your stocks in China, on our exchanges as well as the American exchanges or foreign exchanges. And so they may actually want to delist them from the United States exchanges. Now, a lot of people see that and they get very concerned because they say delisting means, it's on the pink sheets or something like that. I won't have access to my shares. From a practical standpoint, what it would mean is if you were to purchase the stock, you would have that in your brokerage account, and depending on your broker, they may require you to transfer your shares to the Hong Kong exchange or something like that. And then that means that there's a lot less liquidity. So if your broker deals with the Hong Kong exchange and you own shares, they may have to sell those shares in Hong Kong, which may take, instead of a few milliseconds after you click the button to sell, it may take weeks for that transaction to clear. So there's a lot of concern with people who are speculating in the Chinese economy and the Chinese markets. And so that ends up kind of pushing down, the value of this company. Now, that's actually a good thing for us, right? Because we're seeing this company now, and we'll talk about the financials here in a minute. But those are kind of the risks, right? That you have to deal with. And as the price, goes down, how do you feel about those risks, and what do those risks entail, for you as an investor?
Hmm. Yes, just to recap really quick, I think you mentioned kind of largely two different kind of risks here. One is the Chinese government cracking down on Chinese companies so that they can't grow into this kind of monopolistic companies that dominate and dictate a particular segment of the market, which Chinese government, from their perspective, it's a threat to their supremacy over the people and over the market. So
Yep.
that's obviously a big risk. One Number two is the delisting aspect of it at the moment. We'll see how that kind of shakes out, but that's been kind of hammering the price of Chinese companies listed here in the U.S. exchanges. Um, but I see that as kind of a temporary thing. The bigger risk, the more fundamental risk, is what is what is the what is the landscape going to look like when the Chinese government crack down on these tech companies even harder, right? I mean, will they do that? Is that even something that they're going to do? Like, will they let Alibaba continue to grow like this? Are they comfortable with that? That to me, that feels like a more fundamental problem or more fundamental risk that you have to kind of manage here.
Yep.
Yeah. Okay. Should we move on to, I guess before we talk about that, let's quickly touch on, we talked about this in the last episode, but let's quickly touch on the key man risk. Alibaba's founder, Jack Ma, disappearing. Just really quickly, just touch on this point, if you could, Hari.
Yeah, so he is no longer involved in the day-to-day operations of the business, and I think a lot of people associated, like they do with Bezos, right? They associated Jack Ma with the company. Um, to me, that risk is kind of gone, right? I think he's been out of operations for long enough now that the business is doing really well. It's continuing to grow. The cloud business is growing. And I think his day-to-day involvement had minimal impact, because they had so many other capable people running the business, that you don't really need him to be uh, around, right? For this. So he may not be the face of the company anymore, but that may be actually a neutral thing, I think, in my opinion, at this point.
Hmm. Okay, great. Let's move on to the next topic, which is valuation. Obviously, this is a very, very complicated business with
Yeah.
many, many different verticals. And with companies like that, it's very difficult to assign valuation just because each businesses have different characteristics. But perhaps you can kind of walk us through your assumptions and how you came to the valuation that you did.
Yeah, so I started with an initial cash flow of around $35 billion. So it's very hard to estimate their free cash flow for a lot of different reasons. They don't break down maintenance capex and investment capex very cleanly. So I use their operating cash flow as the number that I started with. And even though that may be less than conservative than saying, taking off some percentage, the reality is I don't know what percentage to take. And so what I'm doing is going to be more constrained with the growth rate. So initial cash flow of 35 billion. Remember, this is a company with a market cap of um, 300 billion. Growth rate has for the last long periods of time have been north of 25%. And I think they're, as I said before, the cloud business is really going to drive growth going forward.
Sorry,
Um,
Harry. This is 25% year over year growth on the top line or the
on the
cash
top
flow.
line, yes.
Okay.
And cash flow has been
Okay.
north of their cash flow has been growing faster actually.
Okay.
But I'm gonna use a conservative for the years 1 through 5, a growth rate of 20%. So I think that's kind of the bear case is that they grow at 20%.
Okay.
And for years 6 through 10, I'm only going to use 10%.
Okay.
Um, so discount rate is always 10%, and they have 2.6 billion shares outstanding. If you're using the American Depository shares, the ADRs.
Hmm.
Um, and so what that gives me is a um, intrinsic value of $414 a share and a margin of safety price of $207 a share. Um, so for comparison, they're currently trading at around $114 a share at the time of this recording. So I think they're significantly undervalued, right? Based on this, and if you look at, I know there are lots of value investors who have bought this company at $200 a share, $250 a share, thinking it was cheap. At $114, the price keeps going down, but the value continues to grow, right? In my opinion, it's the cloud business is going to be much larger than it is today. The retail business is going to continue to grow and spin off a lot of cash. They're going to continue to expand into new areas in Southeast Asia, Turkey. Their AliExpress site is growing at a fairly rapid clip. So you're just going to see more and more users, of their services. More and more businesses adopt their services over time. Their 2036 target of 2 billion in users or consumers of their platform is, I don't think, is unreasonable. They're already at close to a billion of them. Um, so I mean, if you're buying a company like this, even if it's delisted, does it really matter to you? Like, you're buying this for the long term. You're getting it at a fairly discounted price. They generate a ton of cash flow. I don't see any existential risk for this company. They're too large for that, right? So really, the risk is, does China cut the growth rate by limiting their ability to acquire businesses and things like that? I think those are much higher, more likely to happen. But I still think just the size and scope of this company is going to let them grow for the next 5 to 10 years at a pretty good clip.
What do you think is pushing the price down so much? We
Well,
talked about we talked about some of them, but if you could
yeah,
kind of just
I think
bullet
the
point them.
the biggest to me is the overall China overhang. Right? Is companies are investors are pulling money out of China because they just don't have a lot of faith in it. One of the things we didn't talk about is the Chinese investor is very short term, nature thinker. So they don't tend to invest in the long term kind of of companies in their own space. And remember, they are traded in Hong Kong. So a lot of people use speculative kind of investments speculative trades, with companies like this, and so they don't keep their money in these stocks. Whenever they see bad, signs, they start pulling away, from the business. So to me, those are the kind of the biggest like overhangs for the company. And then there's every day there's some trickle of this or some trickle of that, which really punishes the stock. But if you look, we're talking about a business that's generating about 30 to 35 billion in free cash flow, and it's 300 million billion dollar market cap. You
So
know,
10x.
10 or less, free cash flow. And even if we were pretty conservative with their actual free cash flow and said it was 25 billion, right? It's still pretty cheap, 12 times free cash flow. You're
Mhm.
not going to find an Amazon trading at that level, right? But yet people are happy to put their money in Amazon. I think China's version of that is just as good, an investment. So
Mhm. What do you think about? Obviously, this is just kind of broad criticism against Chinese companies. How would you think about the integrity of their numbers?
so I think at the size and scale that you're talking about here, it's pretty hard for them to be, faking $100 billion in revenue. Even if they're off by a couple billion here and there, it's not materially impacting the, you know, other than the reputation, right? I'm not very concerned about that because I think it's pretty hard for them to, um, kind of fudge these. If there is any issues here, it's much smaller, kind of impact to their company, right? And
Mhm.
I also think that they've gotten to this size and scope because of savvy financial decisions. They generate tons of cash flow that are auditable. You're right. The cash on the balance sheet and so forth is auditable. So it's pretty hard for me to say, I wouldn't trust it. Much smaller companies, sure, you'd need to be a lot more careful about, but not
Mhm.
a company this size.
Mhm. Okay, great. I think that brings us to the end of the podcast. Any other last parting words about Alibaba? All right.
Yeah, like I talked about in the last episode, I'd encourage people to read this one, even though it's a complex business. It's a well laid out plan. They talk in great depth about their own risk factors, which is worth perusing and seeing how the company responds to that. Wall Street's kind of response to their annual investor day was pretty lukewarm, which I'm frankly shocked by because they're just it's a machine that's printing money. I don't know why you wouldn't want to to invest at this price, right? Especially when we're talking about with conservative estimates, almost a 50% discount to their margin of safety price and a 75% discount to their intrinsic value. So this is a company that should probably be $1 trillion business is trading at $300 billion.
Yep. It's the China discount.
Yeah.
So we'll see. We'll see how that materializes in the coming weeks, coming months. Great. Thanks, Harry, for the rundown. If you guys would like a copy of the checklist, please email us at info@valueinvestor.org. And we do have a Slack channel that we run. And so if you'd like to be part of the Slack channel where we post interesting articles, talk about different stocks, if you have any questions about the podcast, that's where you can find us and reach fellow listeners, fellow investors there. So if you'd like to be part of that community, also email us at info@valueinvestor.org. All right.
Yeah. Thanks everybody. And, we're making a push on YouTube. So, please like, comment, and subscribe. That really helps us, beat the YouTube algorithm and help us grow this. I think we have a lot of good things coming in 2022, and uh, I want you know we want to keep this thing going. So help us out by participating in one of the many areas that Becco mentioned.
Awesome. Sounds great. Well, thanks everybody for listening. I'll see you guys in the next episode.
Thanks.
Bye.
Bye.